Hi guys, welcome to Everything Money channel. Paul and I wanted to slow down a bit. We've been doing this for 2 years. At the beginning of the year, we had 87 subscribers. There's now 2,200 of you. It's been growing like cats and dogs. They'd say that they don't say that, but we wanted to take a moment. We wanted to take a moment and just welcome you. If you're new to the channel, we have viewers all over the world. This channel is really about we do stock investment. We do market watch type stuff. We do real estate. We do business growth. And we wanted to slow down just a smidge.
I like teaching.
Go on.
I still supposed to because of COVID though. I taught at my high school, every week for the last 8 years, an investing class to juniors and seniors. I just thoroughly enjoy it. I do it for free.
This is the basis of this show, is that Paul is a multimillionaire with many, over 20 businesses over the past 10 years, 1,000 real estate properties, and and so you're not watching some guy in his basement tell you his thoughts on the market. This is careful, calculated discipline about how someone
almost too disciplined, right?
Almost too disciplined. We get and so and who am I? I'm just a guy. I'm a wedding photographer in Akron, Ohio, with a family. I knew very little about any of this, and
still don't know very much about it. To be honest.
Thank you, Paul. And I'm representing you. I'm representing you as a viewer, asking this guy questions. So what we're trying to give you is a little more exclusivity. Thank you, Paul, to Paul's mind, so that you can learn how to invest. I do have a PhD. That is funny you said that, Paul. I do have a PhD. Oh my God. So with that said,
let's talk about the 8 pillars and what happened.
If you're joining us, we use an 8-pillar system analysis to look at the health of a company, what they make, what they spend.
Do you remember how it started though, Seth?
No, Paul, tell me.
You don't remember how it started?
I don't recall. So
when I was doing my stock analysis, I always found myself going to certain attributes that mattered to me. They weren't, if the company had them, I'm buying it for sure, and the company didn't have them, not buying them. Mm-hmm. But I remember you saying to me one day, hey, Paul, we just got to go through your analysis. And then I said, I remember a friend of mine years ago said to me, if you ever come up with some sort of method, you have to name it. Mm-hmm. So I started counting. I'm like, okay, well, let me look at all the things I do, and it ended up being 8 things. Yes. I just said, I call it the 8 pillars. It's kind of like, these are the things that I kind of look at to hold a company up. Are they good? Are they bad? Do they tell a story?
Now, that's a very nice story, Paul. I'll go to my grave and knowing that I came up with the term pillar.
You did not.
But Paul's going to say he did. But regardless,
no, I did.
Regardless, let's go.
1,000% it was me.
Here's what we're going to do.
You do not really think it was
Here's
you,
what we're going to do. We're going to look, listen.
Seth, say swear.
I swear.
I said pillars.
Here we go. What we're going to do, we'll go back to the tape. What we're going to do.
Go back to the tape.
We're going to go, here's what we're going to do. Paul, you got me thrown off here now. Damn. With all this said.
Remember I said the whole, let me guess, you're going to take the Everything Money.
Ignore this guy. I'm going to cut his mic here in a minute. With all that said, you don't have to give us a nickel of your money. All you have to do is make sure you smash that like button in the right corner. Subscribe if you want more. And listen, if you're looking,
even saying
if you're looking
for, that's brilliant. That's great. I remember you saying that.
If you're looking for a fly-by-night stock analysis, you're welcome to go to some other Yahoo in his basement talking to you about cats and BS. But Paul and I are going to give you the disciplined approach to how to look at companies, and he's going to do it right now. He's going to stop messing around. And he's going to go right now. Paul, tell us.
I definitely said pillars.
Tell us.
You really think it was you?
Pillar number 1 is PE.
He's ignoring me.
PE ratio. What is PE ratio, Paul? Tell our viewers.
Say swear you really thought it was you.
I did. I really did.
No, it wasn't.
Keep going. PE ratio number 1. Before you as a viewer turn Paul off.
You've never said pillar in your entire life.
Tell them what PE ratio is, Paul.
All right, guys. So the first one is PE ratio. Now, this is what everybody goes to all the time. Price divided by earnings. Mm-hmm. Now, when I say price, I don't look, you can look at the price of the stock. I look at market cap. That is the market capitalization of the company divided by the earnings of the entire company. All right? So the market cap is easy. It's just merely the price of the stock per share times the number of shares. Okay? So that's the market cap. This will tell you the PE. The historical average, history equals 15 to 16. That's the historical average of PE ratio. We look for things less than 20 because if a company is growing, we are willing to pay more for that growth. Mm-hmm. Are you going to take the credit for PE ratio too?
I knew you were going to pause and really, you're really flustered about the pillar.
Are you going to go back and say to everybody that it was PE?
Like right off the bat, guys, if you watch our episodes, PE is the first pillar we look at, and I'm so glad I came up with that. But really, PE is the first pillar, and it's usually an automatic indicator for Paul whether a stock price is well within its range, or it's just overpriced. For example, great PEs for more profit. I'm sorry, where am I going with this, Paul? We see PEs of like 9, 10, up to 20. Tesla is like 1,600. Overpriced companies are insane. So
did you come up with the name Tesla too?
I did. Keep going. Yeah. So pillar number 2 is profit margin.
Profit margin. Now, again, this is not set in stone. I kind of like a profit margin greater than 10%. Does that mean I'm not buying a company that has less than 10% profit margin? Absolutely not. But it's all about how they make their money. The more inventory they have, the more they have to hold on to things. I want a higher profit margin. I looked at a company yesterday with 1.9% profit margin. I didn't say no because of that reason. But I'd like to see over 10% profit margin. And this is very easy. Net income of the company divided by total revenue. Okay? Very simple. These are on the income statement. You're going to find these on the income statement. Go down to net income after tax, divided by revenue, and we want it to be greater than 10%.
We find that retail companies are usually in like the 4 percentile, 9%, and then software companies are just slaying it with like 80% profit margin. Speaking of revenue, pillar number 3 is revenue growth. Why do we look at that, Paul? That's kind of obvious, right?
Well, yes and no. Revenue growth is nice to see. Remember though, I'm not necessarily going to say to you, you shouldn't buy a company that's not growing your revenue. But we like to see some revenue growth. We like to see how they're growing because it makes us feel warm and fuzzy and see some much more upside potential to the company. You should be willing to pay a higher PE for the faster revenue growth. All I'm doing here is I'm doing a 5-year revenue growth number. I just look at the 5th year ago. 5 years ago, what was the revenue? Today, the last year, what was the revenue? If it's higher, check mark. If it's lower today, then it's an X. Very simple.
Pillar number 4 is just profit growth along similar lines, Paul.
Profit growth, same thing. Now you're going to say, well, do you want a certain amount? No, I don't. There's no specific amount. I just sit there and say, I want to see, are they growing now with profit? With profit growth? I do want to see growth there. It would concern me if the company's profit is falling and falling and falling. Because if their revenue is falling, they should be doing other things to avoid their profit from falling. So I do want to see, this is very important for the profit growth, that I do see growth in it. Again, do you not buy companies that have profit growth, that don't have profit growth in it? No, of course not. But you sit there and figure out, you sit there and say, hey, if a company, like say for example, let's do this example actually. Let's say a company you knew was going to make $5 this year, $4 next year, 3, 2, 1, and then be out of business.
Uh-oh.
Would you pay 0 for this company?
I get confused when you ask this, Paul.
Well, you're going to have $9, $12, $15 of profit over the next 5 years. Shouldn't you be willing to pay something for $15 of profit?
I guess so, yes.
So that's the whole point. Even though it might be decreasing in profit, it's still worth something.
Okay,
if they had no debt, no other, they're just generating cash. I mean, even though it's going to be non-existent in 5 years, doesn't mean the company's worth 0. They're still going to generate $15 in profit. Would you pay $5 for it? I'd pay $5 today to be able to get $15 in the next 5 years. Mm-hmm. So that's the point. Everybody else looks at it and goes, oh, this company's dying, I don't want it. No, you just have to sit there and figure out, okay, what's it worth to me? And that's where people get a little confused. Now, same thing goes. Flip this around. Let's say the company was making 1 today, 2 today, 3 today, 4 today, 5 today. What are you willing to pay for this stream of $15?
You tell me.
I'd probably pay more than $5. Why? Because I see growth here, which means in the future it could go even more. So the exact same revenue over 5 years has a different price based on what the potential is.
Now the third variable is, what about a company like Tesla that has this extreme hype and fandom?
Great,
but their growth is very slow. Right? Wouldn't you say that people are paying now for growth that has yet?
So that's
to
what
come?
changed. That's what we're going to talk about soon, about buying a company versus buying a stock.
Yeah.
All right. So we'll talk about that after we do the next one. Number of shares outstanding.
Let's do this. Pillar number 5 is number of shares outstanding.
Okay. Now this is a big one. Number of shares outstanding.
This literally means how many actual shares of stock are out there, and are they increasing or decreasing?
I like to see decreasing shares outstanding, or the same. Decreasing or even.
And this just means that companies can indeed
I keep going in my head. I definitely came up with pillars.
Well, I'm glad you said that. I just pulled up a document from a year ago that I was using for my company that's entitled Pillars of Selling. We're going to do so we'll get to that.
It doesn't exactly prove it, but it very well could be it.
Yeah, of course, while you were talking, I looked it up. So.
I'm glad you did. Because I'd rather be wrong on this than right on it, because it would drive me nuts if I was right on it going, he's wrong.
So I guess what you
I'll
need to know.
give it to Seth, even though it's not
what
true.
you need to know as a viewer is that, which I didn't know, is that companies can just make up shares, Paul. They can just make up shares and just like we're selling.
But why would they make up shares? Why do they create shares?
You tell me, because it seems like a shiesty thing to do.
So first off, let's understand what number of shares outstanding is. Let's say a company had 10 shares outstanding and you owned one of them. How much do you own of the company, Seth?
10%?
Correct. Now let's say they want to make an acquisition, and this is why they'd create shares. They'd go to a company and say, hey, we want to buy you. And they say, but we're going to give you 5 shares. We're going to create 5 shares out of our company, make it 15 shares, and you're going to get 5 shares of our company. Now all of a sudden you own 1 share of 15. 6.7%. Is that the math right? I think it is. 1 out of 15?
Yeah, go on.
I think so. Whatever it is, you own less percentage of the company. You still own your 1 share, but you own less of it.
So do they announce, I mean, as a shareholder, do I have a say in whether they're going to sell off, or do they announce this and I feel sad? Or
you should just know it as part of you know that they have the ability to, and that's the whole point of understanding management. This is the qualitative aspect of the business you need to understand. Is management on your side? Can they make acquisitions that generate a lot of value for the company where this is okay? Absolutely. But history has shown in stocks that they don't do that.
Interesting.
I've seen companies increase their shares for good reasons. We're going to make an acquisition, and it's cheaper for us. We're going to use expensive shares to go make acquisitions. Great, more power to you.
Mm-hmm.
But you have to wonder about that. Kind of tells you about, are they trying to create shareholder value, or are they trying to make acquisitions to make themselves look better?
Should we move on? Pillar number 6?
No, not yet.
Go on.
Now, when his shares go down, here's the interesting part. Here's why it's better. You have 10% here, right? Now let's say they buy back 2 shares. Now there's 8 shares outstanding. How many do you own? You still own your 1. But now you own 12.5% of the company because you own 1 of 8. And here you own 1 of 10. Do you see how that works?
Yes. Go on, keep going.
So that's the big thing here about why decreasing shares outstanding is a good thing. They can increase your ownership of the company just by buying shares back.
Great. Let's move on to pillar number 6, which is current assets greater than current liabilities.
Okay. Current assets. What are current assets, Seth?
This is just like the cash they have in their bank account, kind of?
Essentially. Now, there's other things involved with it. There's inventory, there's receivables, but for all intents and purposes, let's call it basically everything that can be turned to cash very quickly. I want it to be greater than current liabilities. The analogy I always give is, let's say you have $1,000 in your bank account, and you have $500 in bills that are due. Are you okay?
Yeah.
Okay, great. I agree. Let's say you have $1,500 in bills, and you have $1,000 in your bank account.
You're in trouble.
You have problems. That's the same thing with a company. I want to make sure that they have at least enough money on their payroll, on their balance sheet to be able to pay their current liabilities. Now, that doesn't mean that just because they don't, it's a bad thing.
Yeah.
It could just be the industry they're in, that they're very much an inventory-based, but whatever the reason is, but go understand the industry. But I think on the S&P 500, about 380 companies have more current assets than current liabilities.
All right, pillar number 7, your number 1 stunner is free cash flow growth. What is that?
Okay, so free cash flow.
Well, I know what it is, but our viewers don't. It's cash from operations.
Free cash flow is cash from operations
minus
less capital expenditures. Now, cash from operations is the money that they make from operating their core business. There's two other cash flows: investing and financing.
Oh, okay.
This is the business cash that's generated from running the business. Capital expenditures is the money they invest back into their fixed assets, like their buildings, their equipment, that kind of stuff. Because at the end of the day, certain businesses require a certain amount of money to be invested in their capital, in their business, in their assets, to be able to sustain themselves. Things like real estate. We put a lot of money into the real estate. You do things to make to sustain the business and keep it growing. This free cash flow, what is free cash flow used for?
I know you've told me in the past it's like paying dividends.
Yep, dividends, share buybacks, and that's how you decrease shares. It can be used for acquisitions.
Oh, okay.
And just in general, growth.
Nice.
So the more free cash flow, the more they can do all these things. Gives you money back, makes your shares worth more money, grows the business. That's why you want free cash flow.
And then the final pillar is price to free cash flow. Over the last 5 years, you want this less than 20.
So guys, just like PE ratio, over long periods of time, free cash flow should equal net operating income over long periods of time. So just like we look at PE of less than 20, we want to look at free cash flow of less than 20. We look at the last 5 years, we average them together. So let's say a company did 2, 4, 6, 8, and 10 in free cash flow. We add them together, 12, 30, divided by 5, this would be 6. It makes $6, multiplied by 20. I'm willing to pay $120 for this company in a roundabout way. Again, the faster the growing free cash flow, the more we should be willing to pay, etc. If it's stable or stagnant or decreasing, you want to pay a less of a multiple.
We will reference back to this video a number of times. This is how we analyze.
Well, we're still going to do more in this video.
Go on.
I want to talk about the wallet analogy.
Oh, go ahead, Paul. This is
I don't know why your Dodgers, you caught me off guard with the Dodgers jersey. You came in, I'm like, oh, Dodgers jersey, look at that.
Yeah.
This is our intern.
Yeah, our intern Nathan came in with the Dodgers. He must be excited. The Dodgers are
Tonight's the game.
Tonight. Okay, Paul, keep going.
Did you watch that game the other night?
Paul, keep going. I love you. Speaking of that, speaking of cash from operations, again, make sure you smash that like
so
button.
We can get some operating cash flow.
Yes, we'd love some operating cash flow too. And you don't have to pay us a nickel. YouTube will pay us. And all you have to do is like us. Go ahead, Paul.
When people buy a stock.
Yeah, this is important now. Get your ears ready.
This is the very big thing, the very big nut of what we're trying to talk about here.
Nut. Good choice there, Paul.
When you buy a stock, you have to remember you are buying a business.
I don't view it like that, Paul. I'm just a normal person.
Listen,
I look at a price.
I can tell you
if
how
it's
many
cheap,
multi-millionaires I know who don't look at it that way.
Well, tell me what's wrong.
When you're buying a stock, you're buying a piece of a business. The analogy I give is, let's say your wallet. Your wallet's right here and has $100 inside of it. There's a wallet available. Not your wallet. It's a wallet's available out there to buy. How much you want to pay for that?
Let me preface this. You know I've had the same wallet since 1994.
I know. Your wallet's older than Nathan over here.
That's right. Keep going, Paul. That's a pretty interesting story. Keep going.
I
threw you off. Go ahead.
Yeah, it's okay. I'm just trying to figure out if you're going to take the wallet analogy from me too.
We'll see. If I came up
So let's say this $100 wallet's sitting there.
Mm-hmm.
We're not going to add any money to it right now. What would you be willing to pay for this wallet?
I'd pay $100 or less.
Correct.
Not $1 more.
You're willing to pay $100 or less because there's $100 in it. Great.
Mm-hmm.
Let's say the wallet itself has no value. $100 less. Now let's say over time it grows to $200.
Why would it grow?
You make money and you put more money in the wallet.
Great idea.
Are you going to pay $100 for the wallet still in the future?
I'd love to.
Correct. You'd love to. Are you willing to pay more for it?
Probably not.
You're not willing to pay more than $100 for it?
More than $200.
Correct.
Yeah.
This is the same thing as a company. When a company exists, you own part of it. You have to look at the assets and the balance sheet like it's your wallet. You own a piece of that wallet. You're okay as long as they keep increasing over time. Now, the market might sit there and say, no, this wallet's only worth $50. So you went and paid $100 here, and all of a sudden here, the market says it's worth $50. Your job as an investor is to realize, but wait, there's $200 in this wallet. I don't care if the market thinks it's 50. I'm going to buy more of these 50 shares because I'm buying $200 worth. But we as investors, most speculators out there who just buy based on the price of the company get pissed off. Guys like me go, yippee, I love this because I see $200 there that's selling for 50. It's a very, very hard concept to get around. It took years of brainwashing myself to understand this concept. But that is the way I look at all investments. Now, throw in there consistent cash flow, and I know this $200 is going to grow to $300 at some point. I now say I'm buying $50. I'm buying $300 worth of future cash flow for $50 because all a stock is the present value of all future cash flows. So today it's $100. If you knew in 10 years it's going to be $300, you're going to do an analysis and say I'm willing to pay maybe $125 for it. Because you're going to say, my analysis says it's going to be $300 in 10 years, whatever the number ends up being. The whole point is your job is to realize that the price of the wallet is different than what's inside the wallet. The price of the company is different than what's inside the company. And as the company gets better and they build their cash flow, even though it's not paid out to you in dividends, it's still you get a piece of that cash. That's still your piece of cash. In fact, what I'm going to do, this is what Warren Buffett suggests in some of his annual letters is, I am going to look at all the stocks I own and put them all together as basically one company and say, this is what I own in terms of assets, liabilities, income, cash flow, everything all together. Because I'm trying to build a group of companies. Like Seth said, I have 20 companies. It's no different than having 20 stocks. You own 20 companies. Not the full amounts, but the pieces of it. And that is what we're trying to do when we analyze a stock. We're trying to sit there and say, how can I buy this wallet for a lot less than what's inside of it?
Love it, Paul.
What button you hit?
That was the air horn, baby. That was bringing the heat.
We have an air horn now?
We do. I would say, guys, if you love all of this, you can join our Patreon page, which we're developing. And by the time you view this, it might already be developed. So look in the description below or in the comments where you can have more exclusive access to Paul. We're not really concerned about making money. We just want to provide more and gain our following. And I would say, in the end, Paul, I have a document from February 2019 entitled "My Top 5 Pillars of Leadership" by Seth Kirchanan. So with that said, you can thank me and
so
your
you
Uncle
said
Paul.
pillars once before, so now all of a sudden it's your thing.
You can thank me for this wonderful show and thank Paul for all the wonderful knowledge. And in the end, make sure you like and subscribe to Everything Money channel with your Uncle Paul and Seth.
It wouldn't be the first time I got that wrong.
I love you, baby. I love you as a viewer. Thanks, guys.